Hi folks, the global bond market is worth more than $100 trillion. Now let that sink in. A market that's bigger than global equities, bigger than global real estate, bigger than every stock, every crypto, every commodity you have ever invested in combined. And yet, most people don't even know how it works. But here's the surprising part: this invisible trillion-dollar market quietly controls everything in your life: your inflation, your job prospects, your GDP growth, your stock market returns, your home loan interest, even how expensive your next iPhone will be gets decided by the bonds market. All of it, directly or indirectly, is shaped by the bond market. Well, most people think that the stock market runs the financial world. Well, it doesn't. The real power lies somewhere else, in a market most people never see, never talk about, and honestly never bother to understand. A market so big, it makes the entire global stock market look tiny. A market so powerful, governments fear it, central banks worship it, and every recession, every bull run, every inflation crisis begins right here. This is the bond market. And here's the uncomfortable truth: if you don't understand bonds, you don't actually understand how money works in the real world. So let's dive into it. Part 1. What exactly is a bond? Let's start with the simplest possible idea. Imagine you need 1 lakh rupees to start a small business. You go to a friend and say, "Can you lend me 1 lakh rupees? I'll return it in 1 year and I'll pay you 10,000 as interest." Your friend agrees. They give you 1 lakh, you give them a written promise saying you'll return 1 lakh after 1 year. This is the principal. You'll pay 5,000 as interest every year, or 10,000, whatever the amount is decided. This is the coupon. That written promise is basically a bond. A bond is nothing but an IOU, which is typically stands for IOU, a promise to repay money with interest. Now scale this idea up. Governments need money too. But instead of borrowing 1 lakh from a friend, they need thousands of crores for building highways, railways, defense, give salaries, subsidies, everything. They cannot run to a bank and say, "Hey SBI, give me 50,000 crores." So they do something smarter. They issue government bonds. A government bond is the same IOU, but on a massive scale. You lend the government 1,000, 10,000, or even 10 crore. In return, the government promises a fixed interest every year to repay your money after a fixed time. So instead of borrowing from one friend, the government borrows from the entire country. Banks, insurance companies, mutual fund houses, foreign investors, even retail investors like you and me. And because governments rarely default, these bonds become the safest asset in the financial system of every country. The simple mechanism of borrowing from millions to fund a nation becomes the backbone of the global economy. Now that you understand what a bond is, the real question is, how do these bonds suddenly decide inflation, stock markets, EMIs, GDP growth, and recessions? That is where the story gets interesting. Part 2. Why the entire economy depends on government bonds. So now you know what a bond is. A government borrows money from millions of people and then promises to pay it back with interest. Very simple. But here's the part nobody tells you. Once these bonds enter the financial system, they stop being just borrowing, they become the foundation of the entire economy. Because government bonds decide the price of money in a country. And the moment you understand that, everything starts to make sense. Let's break this down. Now we'll focus on every particular aspect of your financial life and how bonds affect it. Number 1, your home loan EMI. Every home loan interest rate in India, whether it is SBI, HDFC or ICICI, it is all indirectly linked to a 10-year government bond yield. If the government has to pay high interest to borrow money, banks also have to charge you high interest to lend you money. So when government bond yields rise, your EMI rises. And when yields fall, your EMI becomes cheaper. Simple. Number 2, bank FD rates and savings rates. Now, banks constantly compare risk-free return from lending to the government versus returns from lending to their customers. So if government bonds start giving higher returns, banks must raise FD rates and savings rates to attract depositors. So the interest you earn on your FD is decided by your bond yields. Number 3, stock market returns. Now, this one is huge. Stock market valuations are built on the idea of cheap money. So when bond yields are low, borrowing is cheap, corporate profits rise, foreign investors pour money and the stock markets boom. And when bond yields rise, borrowing money becomes expensive, consumer demand slows, FIIs might pull the money out and stock markets may fall. This is why stock market shifts have been seen, and they are more related to bond yields rather than corporate earnings. Number 4, GDP growth and the economy. For an economy to grow, companies need cheap loans, easy funding, higher spending, and confidence to invest. All 4 depend on low bond yields. If the bond yields spike, borrowing slows down, investment slows down, hiring will slow down, growth slows down, and GDP takes a hit. In fact, many recessions start with rising bond yields long before the public even notices. Number 5, inflation. Now, this is where the bond market becomes the economy's early warning system. If investors believe inflation will rise, they demand higher yields to compensate. So, rising bond yields often signal inflation is coming. And when bond yields fall, it usually means that the inflation expectations are cooling. Number 6, government budgets and spending. When yields rise, the government has to pay more interest on fresh borrowing. That means less money is left for growth, railways, welfare, education, healthcare, etc. So high yields is equal to tight budgets is equal to slower development. Lower yields is equal to more fiscal boom and more growth. And this is the sole reason why global investors always say that stocks are just the noise and bonds are the truth. Because the bonds market have the potential to tell you where the economy is going before anything else does. Now let's come to part 3. How bond prices and yields work and why do they move in opposite directions. Now in part 2, you must have understood that it's the bond yields that are driving a lot of decision making in financial markets, but how do they actually work? Well, when you hear any news anchors say that the Fed has hiked rates or yields are rising, they're talking about the same thing, which is the cost of money set through the bond market. If there is one concept that unlocks the entire bond market, it's this. Bond prices and bond yields move in opposite directions, always and everywhere. At first, this sounds weird. Why should something becoming cheaper will make its return go up? So let's break it down with a simple example. Let's take an example of a 100 rupee bond. Imagine the government issues a new bond today and you give 100 rupees to them. Government pays 7 rupees interest every year. Now this means that the yield is 7%. Now picture this bond which starts trading in the market. Thousands of investors buy and sell it every day. Suddenly the demand drops and the bonds market price falls to rupees 95. But remember the coupon, the 7 rupee interest does not change. It is fixed. So now the new investor who buys this bond for rupees 95 still gets rupees 7, which means their yield now is rupees 7 divided by 95, which is equal to 7.36%. The bond becomes cheaper, the return became higher. This is why when price goes down, the yield goes up. Now imagine the opposite. The bond becomes popular. Everybody wants safety of government bond. The demand goes up. The price rises to 105. Coupon is still 7 rupees. That doesn't change. Now the yield becomes rupees 7 divided by 105, which is equal to 6.66%. The price went up. The yield went down. So whenever the price goes up, the yield will automatically come down. Now, why this happens in real life? Because the coupon is fixed, but the market price keeps on changing based on the various factors. For example, inflation expectations, liquidity in the markets, FI inflows, interest rate outlook, risk sentiment, government borrowing plans. So all of this affects this. So the yield basically adjusts to reflect the market's expectations about the future. The simple way to think about this is that the bond yields tell you the real return of the market demands at this moment. If people are scared, they buy bonds, prices go up and the yields fall. If people expect inflation, they sell bonds, prices will fall and the yields will rise. In other words, bond yields are the economy's mood swings. Bond prices are just the reflection of those moods. Rates go up when prices go down, rates go down when prices go up. The single dance between price and yield runs the entire economy. Part 4. The bond market is the economy's early warning system. Now, most people think stock markets react the fastest. The stock traders can sense danger before anyone else. The equity markets price in everything. The truth is the opposite. The bond market sees the trouble first. The bond market screams before the crash. And the stock market is always late to the party. Why? Because bond traders don't care about hype, momentum, or narratives. They care about inflation, growth, debt, and economic reality. And that is precisely why Ray Dalio, one of the most successful equity investors in the US, keeps on saying you need to know about the bonds market before anything. And these forces show up in the markets long before they show up anywhere else. Number 1 being the yield curve, the economy's health report. Imagine there are 2 loans taken by the government, one for 2 years and one for 10 years. Normally the 10 years should have a higher yield than the 2 year. Why? Because lending for longer is riskier. A health economy looks like this. 10-year yield is greater than a 2-year yield, but when the 2-year yield becomes higher than a 10-year yield, that is called an inverted yield curve. And that is the bonds market's way of saying that the next 1 to 2 years will be worse than the next 10. Now that's not normal, that's fear. Number 2, every major recession was predicted by bonds. This is where it gets scary. 2008 financial crisis, the yield curve inverted in 2006 and the recession hit in 2008. The bond market saw it 2 years earlier. 2022 tech crash. The US 10-year yield started shooting up in late 2021 and the bond market said inflation is coming, rate hikes are coming. So the tech stocks crashed in 2022, months after. If you remember, even the effect of this was not just in the US and also in India. Number 3, why the smartest money watches money and not just charts? Stock traders wait for news, bond traders move before the news. Stock traders wait for earnings, bond traders act on inflation expectation months in advance. Stock traders react emotionally, bond markets react logically. This is why in global finance there is a saying, stocks are where you see the story and bonds are where you see the truth. Number 4, the bond market doesn't predict the future, it basically prices it in. When yields move sharply, it means growth assumptions are changing. It means inflation expectations are shifting. It means that the economy's direction is turning. It means risk appetite is collapsing or surging. By the time the common investor reads headlines, the bond market has already moved. Because bond yields don't wait, they don't guess, they adjust instantly. That is why they're called the early warning system of the global economy. Part 5. Why retail investors must understand yield cycles. At this point, you might be thinking, okay, I get what bonds are, I get how yields move, I get they predict the economy, but here's the real question. Why should you care? Why should a retail investor track bond yields? Why not just focus on stocks, SIPs and mutual funds? Because in the real world, yield cycles decide your financial life long before you feel it in your portfolio or in your personal finances. Let's break it down. Number 1, yield cycles decide whether you should buy or avoid long-term debt funds. When yields are falling, bond prices rise, debt funds give great returns. When yields are rising, bond prices generally fall and debt funds struggle. Many retail investors lose money in debt funds simply because they enter at the wrong point in the yield cycle. If you understand the direction of yields, you understand the direction of returns. However, if your plan is to stay invested for the long term, this might not be your issue. Number 2, yield cycle decides stock market valuations. Most retail investors think markets move on earnings. But a large part of Nifty, Sensex, S&P 500 valuations depend on interest rates. Because when yields will fall, valuations will expand, bull markets come. And when yields rise, valuations compress and corrections can come. So tracking yields make you smarter than 90% of the retail participants who only watch stock prices. Number 3, yield cycles decide FI inflows into India. Foreign investors constantly compare US 10-year yield and Indian 10-year yield for them to invest in India. If US yields rise, the money leaves India and goes back to the US. And if the US yields fall, India becomes attractive. Understanding yields is equal to understanding the global money flow. Yield cycles protect you from panic. Most investors panic after the markets fall, but bond yields warn you before the markets fall. If yields rise rapidly, the markets will weaken, liquidity dries up, borrowing slows down, volatility increases, and if yields fall sharply, the growth optimism increases, the risk assets rally, liquidity returns. Yield cycles act like a map. They show where the economy is headed, not where it already is. Yield cycles help you stay invested for the long term. When you understand why markets fall, higher yields, higher inflation or tighter liquidity, the fall stops feeling mysterious or scary. You stop reacting emotionally, you stop making impulsive decisions, you stop withdrawing at the wrong time, you start thinking like an investor, not a trader. And that changes everything. Well, to sum this up, you don't need to become a bonds trader, you don't need to decode every macro signal, but you do need to understand one thing. Yield cycles shape the world of money, and if you understand them, you'll never be confused about markets again. The single idea can make you calmer, smarter, and far better at building wealth, despite the world turning uncertain for all of us. So this is it, guys. We hope you liked the video. Tell us more in the comments about the topics that you would like to understand, and we'll deliver it to you. Subscribe to the channel and keep watching for more.